Welcome back to the Daily Crypto Roundup, the show that cuts through the chaos and brings you the clearest look at what's really happening across the crypto markets. And today has been one of those days where everything feels like it's hanging by a thread. Bitcoin struggling to hold key levels, nearly 400 billion evaporating from the market in a week, liquidations hitting numbers we haven't seen in months, and the entire risk landscape shifting under the pressure of global macro sentiment. We're going to break all of it down today. And more importantly, we're going deeper into why each of these moves matters, because none of them exist in isolation. They're all connected. But before we get into any of that, I want to take a moment to say something genuinely important. Over the last few days, so many of you have stepped up and given the show 5-star ratings, and I can't tell you how much that has helped. Moving our podcast feed meant Spotify throttled us in the algorithm. It's not personal, it's just the way the system works. But we were unsure how quickly we'd recover from it, until you stepped in. The number of you who took the time to rate the show, support the content, and keep this community moving, we've honestly been humbled by it. Those ratings mean new listeners get shown the podcast again. It means our regulars don't lose us in their feed. And it means the growth we've been building doesn't get derailed. So thank you, truly. And if you haven't rated the show yet, you know what to do. 2 seconds. And it genuinely keeps this whole thing alive. Right, let's get into the markets. Bitcoin right now is sitting around $83,700, and the tone surrounding the move is uncertainty. It's not a hard collapse, but it's not a confident consolidation either. It's that horrible middle ground where markets feel heavy, hesitant, and nervous. Traders are waiting for signs of strength that aren't coming, and the lack of momentum is starting to feed into the narrative. Ethereum is holding just above $2,720. It's stable, but not strong. It's not selling off violently, but it's not attracting dip buyers either. XRP is sitting just under 195, and to be fair, given the red across the board today, XRP is one of the more resilient names. BNB remains steady around 819, as BNB often does on these kinds of days, barely moving and doing its own thing. Solana is around 126, drifting but nowhere near the kind of collapse you'd expect on a day like this. Cardano is hovering around 40 cents, Dogecoin around 14 cents, Tron around 29 cents, Litecoin sitting at about $81, and Bitcoin Cash just a little over $500. Now let's get into what's actually causing today's moves, because there's far more depth behind them than just the market is down. The pressure started early when Reuters reported that Bitcoin is now firmly caught in a flight from risk environment. And this is important, because this wasn't crypto behaving irrationally. This wasn't whales manipulating the charts. This wasn't an exchange issue. This was a global macro move, the kind that drags everything down with it. Investors across multiple markets were pulling money from anything high risk and piling into safe havens, cash, short-term treasuries, and defensive positions. And when that kind of rotation happens, Bitcoin gets treated exactly the same as a high-beta tech stock. One analyst quoted in the Reuters piece actually said the line that summed up the entire day. Bitcoin is behaving like a leveraged tech stock, not a hedge, not a safe haven, just pure risk. That's the reality of the market right now. Bitcoin is no longer moving independently. It's tied directly into global macro flows, and today was a perfect example of that. Yahoo Finance followed that up with a broader look at the damage, and honestly, the numbers speak for themselves. Nearly 8% wiped off the entire crypto market in a single session, which pushed total market cap back under the $3 trillion level. But what really told the story wasn't the red candles. It was the lack of buying volume. ETF inflows have gone from strong to stagnant. Yesterday's inflows were muted. Today's were even weaker. And that absence of institutional support leaves the market exposed. When ETF flows slow down, liquidity becomes thin. Thin liquidity means every sell order has more impact. It means liquidations hit harder, and it means retail panic amplifies everything. Business Insider added another layer by pointing out that Bitcoin is now moving toward its worst month since 2022. And the key driver behind that isn't retail panic, it's margin calls. This is the detail people miss. When leveraged traders get liquidated, they don't choose to sell. They have to sell. And when markets are already thin, those forced sell-offs cascade. One liquidation triggers another, which triggers another, and before you know it, the price drops don't match the fundamental reality anymore. They're just the byproduct of leverage unwinding. Analysts interviewed for the Business Insider report described it as a deleveraging cycle. And that's exactly what it is. Crypto has been heavily leveraged for months, and now the margin air is being squeezed out, whether traders like it or not. And if you want proof of how deep that deleveraging runs, just look at what the block reported about corporate crypto treasury firms. These are publicly traded companies that hold large amounts of digital assets on their balance sheets, and collectively, they've seen their market caps drop from nearly $176 billion down to $99 billion. That's not a dip. That's a structural contraction. These are the companies that the market looks to as institutional signals. And when they fall that hard, it tells you how much of the sell-off is tied to broader financial pressure, rather than crypto-native issues. We are going to take a short break here for our sponsors. Stay with us. The clearest sign of just how extreme today's move was comes from the liquidation numbers. Decrypt confirmed more than $2.2 billion worth of liquidations in just 24 hours. Bitcoin long positions blown apart. Solana longs wiped out. Dogecoin traders liquidated. XRP traders caught in the crossfire. It didn't matter what you were holding. If it was leveraged, it got hit. And liquidations are the worst kind of sell pressure because they're automatic. They don't wait for better prices. They don't negotiate. They just dump into the order book at whatever level is available. When millions of dollars worth of positions all close at once, that's when markets collapse far faster than they should. But even in all of this, we have one strange, fascinating bright spot: XRP. According to the report from 24/7 Wall Street, XRP is up nearly 89% over the last year, compared to Bitcoin's 3.6%. That gap is massive, and the more you look into it, the more interesting it becomes. XRP's strength isn't coming from hype. It's coming from legal clarity, renewed confidence from institutional traders, and unusually strong buying pressure from Asia and the Middle East. In a sea of red, XRP has been the quiet outperformer for months. Today doesn't change that. We also heard from Binance CEO Richard Teng, who made a surprisingly measured point. He said Bitcoin's volatility today is in line with other major asset classes, and he's not wrong. In a world where AI stocks swing 10% a day, where bond yields are jumping around, and where the global risk sentiment is shifting every 24 hours, Bitcoin isn't an outlier anymore. It's becoming part of the broader financial system. And days like today prove that. And finally, Axios reported the statistic that summed up the entire week. Nearly $400 billion wiped out across crypto in 7 days. 400 billion. Gone. And the reasons tie back to everything else we've talked about. Low liquidity, intense macro pressure, over-leveraged positions unwinding, and a market that simply hasn't found its footing yet. But here's the interesting part. Even with all of that, there are signs the market may be closer to stabilizing than it looks. Not reversing, stabilizing. The selling pressure slowed midway through the day. Buyers started appearing at key levels. Not enough to start a rally, but enough to stop a collapse. And when markets behave like that, it often means the panic is beginning to exhaust itself. What comes next will depend on macro conditions, ETF flows, and whether the liquidations finally settle down. But days like this often mark transitional moments. Not the end, not the bottom, but the middle phase of a shakeout that clears the way for whatever comes next. And the last thing worth mentioning today is how unusually emotional the market feels right now. If you look across social feeds, analyst commentary, trader chat rooms, even institutional notes, there's this strange mixture of fear, confusion, and frustration. But not capitulation. That's important. True bottoms are silent. Everyone disappears. This isn't that. People are angry because they're still engaged. They're analyzing, complaining, arguing, guessing. All signs of a market that's bruised but not broken. And when the panic loudness starts to peak like this, it often means the real selling pressure is closer to ending than beginning. It doesn't mean the bounce comes tomorrow, but it does mean the market's emotional cycle is reaching a critical point. The moment where fear stops creating new sellers and starts exhausting itself. Make sure you follow the show, rate it 5 stars if you haven't already, and drop a comment to let us know you're listening. And as always, we will see you at the top.